it's business as usual. You've not seen too much of unusual activity as far as this entire issue of pledge shares goes.
No, I think Deep, the important thing to note is that the question of pledge shares comes up whenever the market tanks and there are margin calls. So I think clearly in this kind of scenario, wherever we see pledging, which is beyond 60-70%, definitely I think even if the business is doing pretty well and cash flows are being generated, there is always a fear in the market that for whatever reason the stock price corrects significantly, that could obviously trigger a margin call. I think we have seen that in the stock of Z Enterprises. So I think clearly, I think this is definitely a double-edged sword, and I think investors should obviously look at the fact that as far as possible, the companies which they invest should have, reasonably less amount of pledging shares, because finally at the end of the day, the market, swings and the market corrections are something which no promoter can have a control on. So I think clearly it's better to stay away from these shares, but clearly from a longer term horizon, I think the lesser the pledging, I think obviously the run rate and the trigger rate upside for the stock is much better.